Hey guys, this is JT from Alpha Play. This is just a video I thought of making for a while and I finally got down to do it. There is one question that many traders like to ask us, and that is, how do you trade economic indicators? How do you trade central bank announcements? For example, the FOMC meetings or the RBA cash rates announcement, or when they release data on CPI, on inflation rate. How do I trade these key Forex events where the market is more volatile and hence, to a certain extent, creates more opportunity? The short answer to that question is that you don't. It is just too unpredictable to most people. But if you want to trade it anyways, here are two key concepts that you must know in order to give yourself an edge to profit from this event-driven volatility. Concept number one, there is a difference between fundamentals and market sentiments. Many think that if Forex Factory, let's say, releases the latest economic data, or when the Federal Reserve Chairwoman shares a view of the global market, that is considered market fundamentals, right? True, but not good enough. Firstly, the terms used and the concepts relevant here are definitely of fundamental or economic in nature. When one says the inflation rate, for example, is now higher, it must be the case where the corresponding currency must be stronger, right? Yes, it is a sound theory, but it is not so straightforward when applied in trading. The reason for this is because most people miss out what we call the mechanism of how monetary policy works. Until and unless the central bank is actually very sure in changing the interest rate, the currency is very likely to range in the meantime. Or worse, the market is going to have a knee-jerk reaction to any news announced, and the supposed correct direction loses steam quickly, and the market starts correcting towards the opposite direction instead. Ever heard of the age-old wisdom, buy the rumors, sell the fact? I don't know who came out with that phrase, but hey, it's a wisdom for a reason. What's really moving the market in a very limited and confusing way to many is that the news simply feeds into the market or traders' sentiment, the elusive market psychology or the herd behavior that seems to trap so many traders in their unfortunate positions. Let's talk about an example, a very recent case on the 15th of February 2017. The context is that the Federal Reserve System has been hawkish. They made a clear stance in their intention to raise the rates 3 times for this year, and the economic data seems to be supporting their stance. Moreover, on the very recent economic data release, the US economy is clearly bullish. As a very predictable result, the most recent dollar index trend has all the reason to be on the uptrend, and it continued to rise from the time I shared this particular chart right here until very recently on the 15th of February. Days later, after Yellen testifies on the Congress, in which she goes on her rhetoric that no, the US has a stronger case for rate hike, the dollar index took a plunge instead. So what gives? The reason why these moves are often confusing and contradicting in a way is because the market is feeding on all the good sentiments and bullishness of all these juicy economic data. And upon a big event such as Yellen testifying in front of the Congress, the bullishness suddenly loses its steam and begins moving the other direction instead. Why? Because fundamentally, nothing has changed. It was all hype and no action, aka sentiment. The next time when you are tempted to trade into this hype of the news or the events, ask yourself this question. Is the event going to drive the market from a very fundamental point of view, actually increasing or decreasing the interest rate, or is the market driven by irrational fear or greed? To recap, events like these are categorized into 2 things, the fundamental or the sentiment. But how do you know how to trade these particular events and where to trade them? This brings us to our next concept. Concept number 2, know your technical analysis, specifically your key trading levels. These key trading levels are called in many names depending on your strategies. They are support and resistance, 200 MAs, Fibonacci levels, etc. They could be derived from various time frames and strategies. And at the end of the day, each of these levels, although coming in various names and forms, could be the exact same levels or zones, meaning to say there could be congruence. In our previous video where we discussed support and resistance, we understood that these key trading levels are where the actions are and where trading volumes tends to spike up to reach higher levels. It is more than often market prices trade to these levels and start correcting or retracing from them. The dollar index case study was a good example how in our forecasting methodology, the Elliott wave, we've identified the key trading level, where there is a high chance that something significant can happen, either to retrace, which it did, or it could even go higher. Here is one more example from our recent trades, the Kiwi US dollar. We've identified the 0.7368 or within the red box as a key trading zone, likely to retrace and trade lower, and so we shorted this pair. And today we still see that this Kiwi US dollar is still trading below this particular key trading level. So what have we got here? Combining these two key concepts, fundamental versus market sentiment news and key trading levels, has given us a powerful tool in our toolbox to find out directional bias, so to forecast both the direction and the end points, rather your take profit levels. Knowing that the market sentiments tends to lose steam after a good run, we can actually trade both the bull and the bear runs, or the before and after of a release of an important news, allowing us to profit more readily from the market, not only using swing or trends following strategies, but also in using scalping strategies as well. Knowing your key trading levels, especially with time-tested methodologies like the Elliott wave, definitely pays off, especially coupled with knowledge on fundamental and market sentiment analysis. In conclusion, it's important to know that the key trading opportunities comes before and after the Forex events, not in the heat of the moment during the release of the data or announcement itself. In fact, since it is always difficult to guess the direction of these moves, it's practically gambling. Trust me, we have been there. Bottom line is, it pays to do our homework, forecasting the directions and finding out the key levels to trade. Thank you for watching this video, and I'm signing out. Again, this is JT from Alpha Play, and I'll see you again. Join us in our upcoming Elliott Wave Masterclass to equip yourself with the understanding and knowledge in forecasting the market with accuracy and precision.